So tonight we are going to be tackling IFRS 15, and based on my plan, next week we are going to be looking at IAS 8 on accounting policies. Upper week we're going to be looking at IAS 24 on related party transactions. Thereafter, we're going to be looking at IFRS 5 on non-current asset held for sale. So you see, those lineup of topics there's little or no calculations there, but they are very germane and they are critical standards that I can conveniently teach it at any point in time, and to ensure that you understand it perfectly. And they are highly examinable. They like this one I want to teach you today. They test it back to back, so you don't want to joke with it. So let's commence our class straight away, and it's going to promise to be very exciting and practical. So this is 8:30, 8:40 practically. Let's see if we're going to be very efficient, so that we would judiciously use our time and finish as soon, so that we judiciously use our time and finish as early as we can. But the target is that we must finish up IFRS 15 tonight. So what are we looking at? IFRS 15 on revenue from contracts with customers. So every one of you here know what revenue is. It's also called turnover. Some people call it sales. And you know by now that this revenue is the very first item you will find in the statement of profit or loss. You will see it there first. So it's very conspicuous. And usually a company with huge revenue, it shows that this company is growing. This company is doing so well. It's an assumption. So it's a very important item in the financial statement. This standard we are looking at, it came up in 2014. Is also a joint effort between the IASB and the FASB. The IASB is the body that develops IFRS. The FASB is the body that develops standards in the US. So over time, they have been working together so that they can have similar standards. So they work together on IFRS 15. You see, this IFRS 15 replaced IAS 18. Before now, the standard on revenue was IAS 18, but now it has been updated to IFRS 15. Not only that, IAS 11 on construction contract was also embedded into IFRS 15, and some other interpretations on revenue that were embedded in IFRS 15. So you see, this IFRS became effective, even though it was issued in 2014, but we started using it from 1st of January 2017. And before now, we have had a lot of scandals relating to fictitious revenue, fictitious profit. And that was because of the old standard we had on revenue recognition. So this new standard on revenue promises to eliminate all that completely. So that's why this new standard is actually good to a very large extent. And also, the way this standard is structured, there is no level of transactions it cannot break down. It will decipher everything, it will unbundle it, and properly account for revenue. Those previous standards on revenue could not do that. So people were putting in or presenting a lot of shenanigans in their books, presenting revenue when it should not be revenue. Now it is well spelled out. So tonight, what I would have to cover is, number one, is the objective and scope of IFRS 15. Then I'll look at recognition and measurement of revenue. Then some definitions, not only contract costs. I will look at some other terminologies that you'd really have to know. Then finally, I'll look at presentation and disclosure. If we're able to achieve all of that, the earlier we achieve it, the better for us. So let's get into it. So the first is objective and scope of IFRS 15. So like 3 or 4 days ago, yes, I can ask you that what is the core principle of IFRS 15? The core principle of IFRS 15. And the question was actually talking about the objective of IFRS 15. And you see, the objective of this IFRS is to ensure that revenue that is recognized in the statement of profit or loss depicts the consideration expected by the entity from the transfer of promised goods or services to customers. Let me stop there. See, this objective is very clear because it's saying that the core objective of this standard is the revenue you recognize in your statement of profit or loss. When you call that item revenue and you put it in your P&L as revenue, the amount you put there must depict the consideration expected by the entity. What it will show is the money you are expecting. What it should show, what if you are putting 100 million as revenue in your statement of profit or loss, it should mean that you are expecting 100 million. And this 100 million must be from the transfer of promised goods or services to customers, which means that you must have transferred goods or services to customers. That goes to show that if you put 100 million as revenue in your P&L, it means that that 100 million is the money you're expecting because you have transferred goods to customers worth 100 million. So the customer is owing you 100 million, or probably the customer has paid you 100 million. But the core thing is that the revenue that goes into the statement of profit or loss must be consideration expected from the transfer of promised goods or services. That goes to show that if you have not worked for a good or service, if you have not transferred goods or services, or if you are still in the process of transferring goods or services, do not recognize revenue. Because what we want to see as revenue in your statement of profit or loss is the consideration expected by the entity from the transfer of promised goods or services. So in the next few minutes we have together today, I'll be explaining to you the steps with which you can achieve that in such a way that whatever amount that is recognized as revenue in the POL must represent what you're expecting from the goods you have transferred. From the goods you have transferred. We have steps to achieve that. You see, this by doing this, you are going to be providing useful information to users of financial statement. You will be providing useful information to investors, to creditors, and other suppliers about they will understand the nature of your transactions. They will understand how much. They will understand the timing and the uncertainty of revenue and cash flows arising from contract with customer. They will understand it that way. If what you practically put in your P&L as revenue is what you are actually expecting, is what you have worked for. So everybody knows that for you to put this amount in your revenue, it means that you have worked for it. You have done the job. You are just expecting money. So how do we achieve this? So that is taken care under recognition and measurement. So according to IFRS 15, the way we need to ensure that you recognize revenue, that your revenue only shows what you have worked for, that it shows what you are expecting from what you have worked for. We said we now use a 5-step model. And all these steps must be followed one after the other before revenue is recognized. So step 1 is we need to identify the contract with customer. Step 2, we need to identify separate performance obligation. Step 3, we need to determine the transaction price. Step 4, we need to allocate transaction price to separate performance obligation. Step 5, we need to recognize revenue when performance obligation is satisfied. These are the steps we want to look at today. As soon as I'm done explaining this with practical examples and explanations, then we can go and sleep tonight. But I need you to know this. These 5 steps, you need to know it by heart. They can ask you, and you need to be able to at least give a 2 or 3 sentence explanation for each of them. It's highly examinable. You need to know them. So let's start picking them one by one and break it down. The first one, which is the first step in the 5-step model for revenue recognition, is to identify the contract with customer. I mean, the step is clear. There has to be a contract with the customer. So, and IFRS 15 says that a contract is an agreement between 2 parties that create enforceable rights and obligation. The key word here is agreement, and it creates enforceable rights and obligation, meaning it has legal and economic consequences. Agreement between 2 parties that create enforceable rights and obligation, meaning if you don't do your own part of the agreement, they are enforceable. They will have legal consequence. They will have economic consequence on you. Now, you see, when we say a contract, according to IFRS 15, a contract is within the scope of IFRS 15 when all these are present. Number 1, the parties have approved the contract, whether in writing, whether orally, and they are committed to it. So approval of the parties, very important. Number 2, each party's rights regarding to the goods or services is identified. Everybody, each party knows what they are supposed to do. I mean, it has to be very clear what goods and services are to be delivered. It has to be very clear. So each party's rights regarding the goods and services to be transferred can be identified. We must see it on the contract. The payment terms can be identified. When is payment going to be made? In what proportion? How many percent is payable at commencement? How many percentage is payable at completion? It needs to be clear. It has to be there. Number 4, the contract must have commercial substance. I mean, we must consciously enter the contract to make money. So we're saying that your risk must change, your cash flows must change. It must have economic impact on you. That contract, the contract has commercial substance, meaning that a contract with your sibling, a contract with related parties needs to be looked at twice. That does it have commercial substance? Is cash flow changing hand? Is risk changing? That has to be clear. There has to be commerce. Buying and selling must take place. Risk must change and cash flow must change. Commercial substance, the contract must have it. It must not be free. And the fifth one is that we have to be sure that we'll collect our money. It must be probable that the entity will collect consideration. We must be sure that we'll collect our money. And finally, this is redundant because it's implied in the first point that the contract can be written, oral, or implied. I mean, not necessarily. This point is already implied in the first point here. You see, the thing is this. You have these 5 points, you have to know it. I don't know how you want to codify it. They can ask you that a contract with a customer is within the scope of IFRS 15 if he has the following criteria. Can you list them? You must be able to tell the examiner that the parties must have approved the contract. Each party knows their rights relating to the goods or services. The payment terms for the goods or services can be identified. The contract has a commercial substance, and it's probable that consideration will be collected. 5 marks. You see, when you have a contract with a customer and it does not meet all the criteria above, I mean all. So you guys are accountants. Some of you issue invoices. Some of you are responsible. Those are done. That means if you recognize revenue and your contract does not contain all of these elements, you're wrong. All these elements must be on your invoice if that's the only sales agreement you have. I mean, in the consulting side, that's where I belong, before we sign up or any client signs us up, there's always an SLA followed by an engagement letter. All these are there in detail. We ensure that it is there. And it should be like that in all industry. We always...
Yes, please, you can hear now.
Okay, good. So when you have a contract with a customer and all these criteria are not present, that means, and let's say, for example, the customer has paid you. That means you cannot recognize the money you collected from the customer as revenue. If you cannot recognize it as revenue, and you have already collected money, so how should you recognize it? The standard says that you recognize this as contract liability. This is what a lot of people, in fact, not a lot of people, everybody, this is what they call deferred revenue. Some people call it deferred income. There is nothing like that. There is nothing like deferred income or deferred revenue. So all of you that are here today, be our ambassador. When you see anything like deferred revenue or deferred income in any account, bring it out, change it, that it should be a contract liability. Because people always interpret deferred revenue as that, okay, oh, you have collected money and you have not done the work. And then they say it's deferred revenue. It's not, or deferred income. No. There is nothing like that in IFRS. Nothing like that. So rather, we call it a contract liability. See, the only scenario where you can recognize revenue for such transaction, where you collected money and you did not meet the criteria above, I mean, you did not, your contract does not satisfy these 5, is where, I mean, I don't know the nature of the contract, but you have no remaining obligation to transfer goods or services. Or the money you collected is non-refundable. Probably the contract is terminated and the money is non-refundable. Well, you put it as revenue, if that's the case. So let me show you some examples of some valid contracts. Let me see a contract is solid and valid. So look at this scenario. A manufacturing company, ABC Limited, he signs a written contract with XYZ Corporation to supply 1,000 units of goods of a product at 15 naira per unit. The contract specifies delivery in batches over 3 months, payment to be made within 30 days. XYZ Co has a strong credit rating. You see, this scenario is a valid contract. Why? Because the contract is approved by the parties. There was a written agreement. Each party's rights for the related to the goods or services is clear. I mean, they mentioned it. Will supply 1,000 units. It's clear. The payment terms is specified. We will pay within 30 days. It has commercial substance. I mean, they are paying. It will affect cash flow. We will collect money. Somebody will pay, somebody will collect money. So cash flow is changing. Risk is changing. And we are sure that we will collect our money because they say that this customer has a strong credit rating. So it meets all these 5 boxes must be checked. It has to be checked. Look at this one. Look at this scenario. A software company, this is the name. He enters into a contract with a small startup, Newco Limited, to provide custom software system for 100,000. So the contract includes a 12-month development timeline. They will pay on completion. Newco Limited has a weak financial history and might struggle to pay. Looking at the criteria of this contract or characteristics of the contract, well, it has been approved because they said they have entered into a contract. They have signed the agreement. Number 2, the goods or services is specified. They said they want to provide a custom software. The payment terms is specified. They say they will pay upon completion. There is commercial substance because this guy is supposed to earn revenue. And this guy is supposed to earn revenue. And collectability is not probable because this guy has a weak financial history and might struggle to pay. You see, because of this one, he cannot recognize revenue. He cannot recognize revenue.
I have a question, Mr. Ose.
Oh, please ask.
And the last statement that emphasized on new company limited, weak financial history and might struggle to pay, to me, sound like mere speculation. So, are we to infer, based on history, and make a judgment of not possibility, but the certainty that they will not pay? More reason why we truly have them marked. But meanwhile, the due time, what if they eventually pay?
Then we recognize
Can we
revenue.
still recognize revenue?
Oh, definitely. So, I mean,
Because I noticed we've actually struck it out that
yes,
revenue cannot be recognized because of
yes.
the past performance.
Yes.
But what
So,
if they turn a new leaf and they eventually pay
yeah.
at the due
Okay.
time?
Yes. I get your question. So,
Can it be huh? Your voice muffled at the point? Maybe it's in
okay,
network.
I think let me switch to actually switched to mobile. Let me switch back to my Wi-Fi. Just give me 1 second.
Hi, we can hear
We
you.
can hear you. We can hear you, sir.
We
Okay,
can
good.
hear you, sir.
hear you, sir.
Okay, good. So again, just so that we won't overflow that. So this, I mean, we are allowed to make judgments in accounting. Accounting is about judgments, estimates, models. It's not an exact depiction. So of course, they will have their reason why they flagged this particular customer. So probably maybe they have had dealings with him in the past. Maybe they have access to his financial statements. But the information right now is that he has weak financial history and he might struggle to pay. So you need to pick that up. And because if you recognize revenue, that means you will have failed the first test of revenue recognition, which is the objective, the core principle of this standard. Because we want revenue that you put in your books to depict the money you're expecting from the service you have offered. So if you know somebody will struggle to pay, don't put it as revenue yet. Until at that point is until the person has paid. That's the reality of revenue recognition now. We need to be sure. We need to be sure. So good question, Wasil. We need to move forward. Okay. Now, another point here is this. We can combine contracts together. Okay. We are still on identifying contracts with a customer. So we don't want just signing several contracts that will make everything so complex, especially for maybe for every service you render to a customer. We are now signing separate contract for all service. So we are saying that, okay, you might be able to combine two or more contracts that you enter into almost at the same time or with the same customer. And you treat all those contracts as a single contract. Okay, if you have two or more contracts that you enter into almost at the same time, the same customer, you can combine all of them together and see them as a single contract if these following criteria are met. And that's paragraph 17 of Ifrs 15. He gave us three criteria. Number one says if those contracts are negotiated as a package with a single commercial objective. It's just like let's say for me, I have an audit client that I'm also providing tax services for. Usually, we would have a contract for audit, we'll have another contract for tax. Okay, so can we combine that together? Depends if we meet these three criteria. If you negotiate it as a package and they all have single commercial objective. And single commercial objective means they want to achieve the same results. The same results. If the result is provide reports, if the result is you want to file returns, whatever it is that is a commercial objective, depending on the service, of course. And also, if the consideration of one contract depends on the price or performance of another contract, meaning they are dependent on one another. If those contracts are dependent on one another, why don't you just combine them together as one? Or if the services in all of those contracts can be delivered as a single package, if those services within those contracts, if they can be delivered as a single package, just why not treat them as one? So let me give you some examples, right? So a consulting firm, Advisory Limited, it signs two contracts with a client. A 50K contract for business strategy review, a 30K for implementation plan. So two separate contracts for these services. However, see, both of these contracts were negotiated together, and this strategy review, it imparts implementation. So the strategy review imparts implementation. I mean, from this information, since these contracts are closely related and they are a single performance obligation, so we should just combine them as one because they are negotiated as one. And this strategy impacts implementation. So mostly they are going to be delivered as a single package. So we just need to meet any of these. Look at another one. A software company called, let's say, TechSoft Limited. He enters into two contracts with a customer. Okay, contract one, software license, 100,000. Contract two, ongoing maintenance and support for 30K. This one is for 3 years. So the customer is given a discount on maintenance only if they purchase the license. Okay, that's the scenario. So again, there are two contracts here. Software license, 100K. Ongoing maintenance and support, 30K. And this one is for 3 years. Then I said they will give discount on maintenance, which is this one, if the customer purchase license. Okay, so you will see that number one, the maintenance contract is priced based on the software purchase. That means the price of this one is dependent on the price of this. And the contract are interdependent because one contract pricing influences the other. So we combine the two contracts. And the 130K contract, we see it as one, and we share the money between software license and maintenance service. Because the price of one depends on the price of another. Look at another scenario. A real estate company, a construction company, Buildco Limited, he signs two contracts with a property developer. Land sale, okay, for 500K. Construction of building on the land, 2 million. Okay. The contracts were signed separately, but are part of the same negotiation. The customer will not purchase the land without construction contract. Again, these two contracts, they are a single performance obligation because the land and the building must be delivered together. Abi? Land and the building must be delivered together. And the contract were negotiated together. So this contract 1 and 2, you see it as a single contract. The contract must be combined as a single contract. Look at this one. A machinery manufacturer enters into two contracts with a customer. Contract 1, sales of machine. Contract 2, customization to modify the machine for 200,000. The customer cannot use the machine without customization. And the two contracts were negotiated together. I mean, all these are saying the same thing. That means they are interrelated. They said the customer cannot use the machine without customization. So that means they are highly dependent and they were negotiated together. So this contract 1 and 2, see them as the same contract. Don't sign different contracts. Just you see them as one contract. Look at that. Let's take this as the final scenario. A Cloud Tech Limited signs two contracts with the same customer. Contract 1, there's a cloud storage service for 50K per year. It's a cybersecurity consulting for 20K per year. The contract were negotiated separately, and the pricing of one contract does not affect the other. Okay. So this one now, since the contract were negotiated separately and the pricing are not interdependent, so this one, we cannot combine them together. We see them as separate contracts. So the key thing here, I need you to remember, when it comes to combining contracts together, we are saying they have to be negotiated. Those contracts must have been negotiated together. The price of one must be dependent on the price of performance of another, and they can be delivered together. And any of them, if they are present, that means you combine them. All the three doesn't have to be present, just any of them. So that's contract combination. Another one is modification. And you know that modification is when there is a change in something. So when there's a change in the contract. So a change in contract in what sense? Okay, so Aisha said, my material is different from what you have. Yes, I just updated this one with more examples. So I'll share this one with you. So a contract modification occurs when there is a change in scope or price of a contract that is approved by both parties. So when there is a change in scope or price, that's modification. So the key thing here is this. This modification, when there's a change in scope, when there's a change, because this happens often. So accountants, you need to know, you need to be aware. When somebody comes, you had a contract before, and he came and say he wants to change the contract. He wants to change the price. He wants to change the scope. So the key thing here is this. Are we going to see that change, that modification as a separate contract? Or we are going to see it as a modification of the existing contract? How should we see it? So IFRS 15 says you should see it as a separate contract if the scope of the contract increases because of addition of promised goods or services that are distinct. Okay, so if the change in scope is that the guy is bringing, the customer is saying that we should do additional service for him. So the change in scope is not just change in price, is the customer is saying, do something more for me. And it has to be distinct from what you are doing for him before. It has to be separate. Or the change in price or the price of the contract increases by an amount of consideration that reflects the entity's standalone selling price of additional promised goods or services. And also, you see, that scope that changed, the pricing of it must be the standalone selling price of that additional goods or services, meaning that ordinarily, if you're going to sell that additional services requesting for, the price you are giving him is the price you'll have charged anybody else. That is, standalone selling price is the price you sell that goods ordinarily, separately to other customers. And I define it for you here. Standalone selling price is the price which the entity would sell a promised goods or services separately to a customer. So before you can treat a modification as a separate contract, please listen and understand the core point here. We are saying modification when there's a change in scope or price. We are saying that change in scope or price, should we treat it as a separate contract or modification of existing contract? We are saying that you should treat it as a separate contract. If the change in scope is because the customer requested for additional goods or services, then fine, that's good. It should be a separate contract. And also the price of that scope change reflects the entity's standalone selling prices. In standalone selling price, you must reflect that. Let me give you some scenarios to strengthen the point. So a construction company, BuildCo, enters into a contract with the customer to build a project for 500,000. During construction, the client requested for additional features for an extra 100,000. The additional features are priced at market rates. at market rates. So now, you see, this is a modification. We are building a project for the clients, 500K. So the customer came and said, he needs additional feature. We told him it's 100K. And this 100K is market rate, meaning this 100K, that additional feature is asking for, if we were going to do it for any other customer, we will have charged 100K. That means this 100K is a standalone selling price. So we're going to treat this contract as a separate contract. It will be a separate contract. Revenue will be recognized on it separately. Okay? So the modification added distinct service at market price. So we're going to treat it as a separate contract. You see, if the additional work were priced at a discount, if this 100K is not at market rates, we will have treated as, we will have bonding it together as part of the old contract. We will not treat it as a separate contract. We will not treat it as a separate contract. We will have just modified the existing contract. Another one, a software company, TechSoft, signs a contract to provide accounting software for 50K, 50,000. Okay. After 3 months, the customer requested for additional inventory management bundle for 20,000, which is priced as standalone selling price. I mean, this is clear. So we're going to treat this additional request by the customer as a separate contract, because the price of that change in scope is a standalone. I mean, they wrote it there for you. Standalone selling price. When they do that, don't just stress yourself. It's a separate contract. Okay. So the additional model is distinct, the price separate. So we treat it as a separate contract. Look at this one. BuildCo signs a contract to build 10 houses for 1 million naira, meaning 100,000 per houses. Okay. So after he completed 4, the client came that, okay, I need additional 5, but now 95,000 each, a discounted rate. I mean, I need not tell you from my explanation so far, the additional 5 houses this guy is requesting for, we will not see it as a separate contract. That is not that's what I need you to know right now. Is it a separate contract or not? So these additional 5 features, we're not going to see it as a separate contract, because this 95,000 is not a standalone selling. The standalone selling price is 100K. So it's giving him a discounted price. It is not standalone. So we don't need to sign separate contract for that. So meaning that when we are recognizing revenue, the 4 that we have built, we recognize revenue for that. The remaining, the remaining 6 is still priced at, because we are building 10 houses. So it's still priced at 100,000 plus the extra 5 at 95. So the remaining revenue is 1.3 million. So the total contract price now has to be adjusted to 1.7 as against 1 million. So we would have to adjust it. Ordinarily, this 5 extra should have been a separate contract, but now we will need to adjust the existing contract. I hope you are getting the idea.
Yes.
Okay, good. Don't worry, Julian, I will share it, okay? I actually worked on it today. Another one, Netcom signs a 3-year internet service contract with a customer for 30 naira. After 1 year, the company offers a discount. So the customer will now pay 25 naira per month. It's just like all these MTN, Blue, and all of that. So you are maybe a postpaid customer, something like that. So they were charging you enter into a contract with them, 3-year internet service contract. You're supposed to pay 30 naira per month. So after 1 year, they started offering you discount at 25 naira. So do you need to present a separate contract for this? No, because there is no additional service here. It's still the same service. Still the same service. I mean, for that reason alone, just adjust the contract. Instead of a contract of 30 naira per month times times 36. This is the original contract. 30 naira per month by 36, 1,080. So we need to modify the contract to show that, okay, the 30 naira was for 12 months, and now 25 naira is for the next 2 years. So the contract price now is 900 naira. So there's a reduction in revenue in form of discount. Okay. So in this case now, we don't have to, it doesn't meet the criteria to be recognized as a separate contract because it's the same service we are offering. The final one, the final one. So a consulting firm advisory limited signs a contract to provide financial advisory for 100,000 for 6 months. So after 3 months, the client came and requested for extension of service for 2 months. And the guy is not paying any extra money. He's not paying any extra. So this modification is not a separate contract. We just need to modify the existing contract in such a way that the amount of revenue we're recognizing per month, because this is a 6 months, 100,000 naira contract. Ordinarily, revenue should have been recognized at every month at 16,000. But now, he wants extension by 2 months. So revenue will be recognized as 100,000 divided by 8, 12,500 per month. So though the one will have recognized for the past 3 months, yes, fine, we'll have recognized 16,067 per month, but going forward, it will be 12,500.
I have
But
a question, Mr. Wate.
yes, but the total contract price is not going to change. It's still going to remain 100,000. Okay, go ahead, please.
Is it possible in a scenario whereby a cash, like a benefit, take for instance, you are to attend a webinar which you have paid ahead for, meaning the cash flow there's a cash flow, there's an intention to receive benefits, which the information that will be delivered to me over a webinar, which I've actually paid ahead. Coming that day, I wasn't opportune to be present owing to a constraint. And the organizer actually delivered it, but I wasn't there to receive the benefit. On that note, can the organizer recognize revenue?
It depends, right? So for them, they cannot track whether you are there, whether you are not. The agreement is that they will just do webinar. Your paid is assumed that you'll be there. So even you are not there, the money is not refundable. And when the money is not refundable, you recognize revenue as soon as you collect them, as soon as you deliver your service. Since the money is not refundable. If the money was refundable now, yes, we will not recognize revenue. Okay, I think that settles that. Okay, so I did a summary here. I would share you this later. So the summary of contract
Fancy,
modification.
please, I have a question.
Yes, Sadiq, go ahead.
Um, it pertains to the can you maybe scroll up a bit? The last scenario. Yes, this particular one. When we're extending, when there's an extension,
Okay.
does this scenario entails the fact that the contract amount still remains 100,000? Because I was thinking, since there's an extension, Of course, the amount should be more than 100,000.
It still remains. That's why, even though we are recognized 16,000 for the first 3 months, going forward, what we're recognizing per month will now be reduced as revenue. So the contract price still remains the same. So which is why, you see, in this instance now, this extension is not a separate contract. All we are doing is we are just playing around with how much we are recognizing per month. It's going to modify our revenue per month, but the total revenue does not change based on the information available to us right now.
Okay, all right, thank you.
Okay, I will definitely share this more detailed notes with you. So this question, I want you to try it yourself because I've already covered it in those scenarios I've mentioned earlier. So, and I would also, there are some practice questions here because I can ask this part a lot. Step 1 is the most detailed part. So there are some practice questions here that are in this updated one, which I'm going to share with you. The solution are also there. So the way I'm going to do it, when I'm sharing the updated note, I will remove this one. I will now share the practice question without solution, just so that you can have something to practice similar to what I've taught you before. So, okay, we are done with step 1. Any questions, please? Any questions? So when you read these notes, things you need to have in mind, that's step 1. You need to know those 5 characteristics of a contract. You need to know contract combination before you can combine 2 contracts together. That they must be negotiated as together and they must have single commercial objective. The price of one must affect the price of another. They can be delivered as a single. You need to know those 3. And there is contract modification. When there is a change in scope and price, can you treat that change as a separate price or adjustment of or adjustment of an existing of the old contract? I mean, we said if the change in scope is that the customer says they want something more, or is an additional goods or service, not relating to the old service, but a new service. And that new service, the price we are charging him is the price we will have charged any other customer. If that's the case, you treat that modification as a separate contract. You recognize separate revenue for that. Otherwise, just modify or adjust the existing contract. And I've given you scenarios to address that. That's step 1. Identify the contract with customer. The step 2, which is identify the separate performance obligation. My dear students, this step 2 is extremely important because when I say separate performance obligation, it means that in every contract, when a contract has been established with a customer, the goods or services that is promised in the contract, that is what we call performance obligation. And it's important that you identify the separate performance obligation because we are very careful with this. If there are more than one service or more than one types of goods that you want to offer, don't just bundle all of them together. You need to tell us in your books. You need to disclose your revenue for each of the goods or services. Don't just bundle everything together. I will give you several scenarios to see. So step 2 is identify those separate performance obligations. Because look at this paragraph here. A company can only account for performance obligation as a separate performance obligation only if the goods and services are distinct. So when you are offering more than one service, the key question is that, is this separate? Can we account for this separate services on their own? I mean, if you can answer the question of distinct, is that service or goods distinct on its own? If it is distinct, then you should recognize revenue for him separately. So in your notes to the account, we should be able to see revenue from different revenue lines. Different revenue lines. Don't just lump everything together, provided it is distinct. So what do we mean by distinct? It's an English word. It's clear, distinct, separate. But IFRS 15 says that it means that goods or services is sold separately because it has a distinct function and a distinct profit margin. A distinct function and a distinct profit margin, which makes sense because anything you sell separately should have a distinct function. And when I say distinct function, it means that the customer should be able to benefit from that goods or services on his own. The customer should be able to benefit from that goods or services on his own. He should be able to enjoy that goods alone, separately. That means that goods has a distinct function. That goods alone can satisfy the customer. And secondly, it has a distinct profit margin if that goods or service is separately identifiable. Separately identifiable. And it is as implied. When we say separately identifiable, it means that goods or services is not integrated into another goods or services. It's not dependent on another goods or services. It's separate. So when we say distinct, it means it must have distinct profit margin and a distinct function. The customer must be able to enjoy that goods or services, benefit from that goods or services on his own. So see, the key thing in step 2 is just our ability to identify the goods or services in a contract. Should we treat them separately or should we bundle them together? Should we treat them separately or should we bundle them together? So we are saying here that if they are distinct, meaning if they have distinct function and distinct profit margin, treat them separately. Recognize revenue on each goods or services you have in the contract separately. But if it doesn't have a distinct function and distinct profit margin, lump everything together. See them as a single performance obligation. See them as a single goods or services. Let's look at some scenario here. Case 1. A construction company called BuildCo. He signs a contract to build a shopping mall for 50 million. The contract includes design and architecture, foundation and structure, electrical and plumbing, interior finishing. You see, all these services are interrelated. They must be delivered together. The customer cannot use any of these separately. What does the customer want to use design and architecture to do? Or foundation? Can he live in foundation? That means it is an half-built mall and has no value. So all the elements must be combined and seen as a single performance obligation until the mall is completed. So here now, you will see that each of these goods or services in the contracts, they don't have a distinct function. They don't have a distinct profit margin. And distinct function means that the customer can benefit from them on their own. The customer cannot benefit from any of these ones on his own. They are integrated into one another. They are highly dependent. They are not separately identifiable. So we are going to see all of this as one service. All of this as one single performance obligation. Scenario 2. A software company called TechSoft Limited, it signs a contract to provide software license, 50,000, 500,000. Installation and customization, 100,000. 1 year technical support for 50,000. Okay. You see, 3 services here. We have 3 services here. It's giving software, you install, technical support. The assumption is this: the software can function without customization, meaning we don't need customization. With the software license, the software is working. So the software alone has, the customer can enjoy the software on his own. The installation, yes, you need to install the software, but it's not like it's essential. The customer can install the software himself. So the installation, since the customer, you don't have to be the one that do it. The customer can get another person to do it. So that means the installation is also is distinct. The customer can enjoy the installation on his own. The technical support, they are telling us that here that it is an optional after sales service, meaning the customer can decide to opt for it or not. So this one too is a separate service. It has a distinct function. It's separately identifiable. So all these 3, we are going to treat them separately. So in your books, when you're recognizing revenue, you recognize revenue for the license separately because the customer can benefit from the license separately. Installation and customization, you recognize revenue for that separately because it's separate, it's distinct. It has distinct function, distinct profit margin. The 1 year technical support. So recognize separately for each of them. However, if the scenario had told us that the customization was essential, that the software cannot work without customization and installation, if they were very clear with that, then that means the software and its installation, we are going to combine them and see them as a single performance obligation, while the 1 year technical support will separate it. So again, you see this software license, since we have given it to the customer, we recognize revenue immediately. The installation and customization, this one will recognize revenue on it over time. The same thing for the technical support. You recognize revenue on it over time. But that's not even the focus here. The focus here right now is for you to understand the fact that these are separate services. Each of them have distinct function. Each of them, the customer can benefit from them on their own, and they are separately identifiable. They are not dependent on one another. Another one is a telecommunication company. He signs a 2-year contract with a customer. He will give a free phone to the customer. Then he will be charging 18 naira per month. I wish they can be doing this in Nigeria. MTN and Glo. If you are listening to this lecture, give us free phone and be charging us for internet.
Yes, well, I agree.
Yes. I mean, that would make sense. But if you work with MTN and they do that, you see, the phone has a distinct function, has a distinct profit margin. So you have to recognize the phone as a separate goods or services. The internet or the telecom service also is separate. You need to, they have a distinct, they are separately identifiable. They can function on their own. They are not dependent on one another. Things you can get it from anywhere else. So they are separate service. They are separate service. The same thing. I mean, we can go on and on with example. This pharmaceutical company, he gave a license to a manufacturer to sell his drug for 200K. And he says he will be providing R&D support and updates for 50 million. Okay, are they separate service? You see, it depends on the scenario. If the R&D support is essential for the customer to use the license, then fine. That means there's a single performance obligation. But if the license allow immediate use without the update, then the license is a separate service. The R&D support is a separate service. So the key around step 2, with all these scenarios I've given you, is looking at these contracts. There might be many goods or services you are offering. Accountants, you need to be able to know that, are you treating these goods or services as a single performance obligation, or are you treating them as a separate performance obligation? And they are separate if they have distinct function and distinct profit margin. That is, the customer can benefit from them on their own, and they are separately identifiable. They are not interdependent on one another. They are not related to one another. Then you treat them as separate and you recognize revenue on them separately. Step 2 is very key. Any questions on step 2?
Yes,
Now,
I have a question, but I would like to postpone my question till the end of all the 5 steps,
oh,
because
thank you
I
very much.
have a scenario. Yes, I do.
Okay, thank you
And
very
my
much.
question, can I hint it before
No,
okay, let me
yes,
postpone to the end of the steps.
exactly. Since you said you were going to wait, so just wait. So step 3 is for us to determine the transaction price. And firstly, transaction price is the money you're expecting. The money you're expecting from the customer. Excluding amount collected on behalf of third party. You see, you find some people including VAT as part of their revenue. Why would you do that now? It's not your money, it's for government. So you should not recognize the VAT element of the money you're expecting. It's not even money you're expecting, it's money you are collecting on behalf of a third party. So it's only the money that you are expecting that is your revenue, which we call transaction price. The VAT element, you're supposed to credit it to VAT payable. Go and pay it to the government. Okay. So you see, when it comes to transaction price or the money you are expecting, there are a lot of variations to it, because the simplest one is when the money is fixed. Meaning, let's say the customer is paying 100,000 for the service. So that one is the simplest form ever. It could be variable, like discounts, rebates, bonuses, penalties, and all of that. Like when the customer gets 10% discounts, if they buy in bulk or if they pay early, something like that. That's a variable consideration. If there's also a significant financing component, a lot of people get this wrong, because if the timing of the payments is so long that the customer is not paying within 1 year, you are borrowing the customer money. So if customer pays in 3 years, interest must be considered. Any sales on credit that is after 1 year, there's a financing component there. You must recognize interest. You need to break down that money you think you are recognizing as revenue. A portion of it, recognize it as interest. I'll show you an example. There could be non-cash consideration. It's possible, yes, that the money you will collect will be goods or services instead of cash. Like if a customer gives you shares, something like that. That's a non-cash consideration. Some of you have learned share-based payments. That's a non-cash consideration to that customer, to that supplier, I mean. The customer decided to give you shares. Or if consideration is payable to the customer, this is also common. that you sold goods to a customer and you promise them to pay them some money. So if a manufacturer pays retailers incentive for shelf space, that's a consideration payable to customer. So for this to make sense, let's look at scenarios for each of them so that this will just take the point home immediately. I won't give you any scenario for this one, fixed consideration, because it's straightforward. Transaction price is clear there. It will be fixed. It's fixed. The amount you're expecting, and it will be stated very clearly. So no issue with that. So I'll give you scenarios for these other four, so you can see it practically, what we mean on each of them. So first is variable consideration. Now, BuildCo signs 100 million contracts to build an airport. Sorry, I need to close. This thing is making noise. It signs 100 million contract to build an airport. So the contract includes 10 million bonus if completed within 24 months, 5 million penalty if delayed beyond 30 months. So this is what the contract entails. So we got a contract of 100 million. But they are telling us that if we finish it early, they will give us 10 million. If you don't finish it early, they will charge us penalty. So how much are we going to recognize as revenue? Is it this 100 million? It depends. If you see that this contract, we're going to finish it in 31 months, just recognize 95 million as revenue. Because it's clear in the contract that they will charge you penalty of 5 million. So your revenue is not 100 million, it's 95 million. That is what we mean by variable consideration. Variable consideration. When it varies as a result of penalty, bonuses, rebates, it reduces your transaction price. Another one is significant financing component where there is a deferred payment. So a machinery supplier, Equipment Co. Limited, he sells equipment to a customer for 5 million, but payment is deferred for 5 years, 0% interest. You see, this one, we are going to see it as you are giving the customer a loan and you sell goods to a customer and the guy is not paying for 5 years. So IFRS 15 considers time value of money. You see, the transaction price is not 5 million, even though, yes, the selling price was 5 million, but that's not the transaction price. This 5 million must be discounted using the market interest rate. Let's say 6% or whatever it is, either you're using the MPR in Nigeria, around 27.25%, whatever. You're going to discount it to present value. You know, when you discount it, it becomes smaller. So it is that present value of 5 million that you put in your books as revenue. You see, the rest, you treat it as interest income. You treat it as finance income. That's how it's done. So any financing component, a finance component exists if payment is deferred beyond 12 months. So note, guys, if you're an accountant, for your exam, this is very key. Watch out for this. When a supplier sells goods to a customer and payment is deferred for more than 12 months, what you recognize as revenue is the present value of that selling price. Because it's the present value of that's the transaction price. Transaction price take note of financing component. Takes note of financing component. Another one is non-cash consideration, payment in shares. So a technology firm, let's say TechSoft Limited, it provides consulting service in exchange for 1,000 shares of a startup instead of cash. So the transaction price here will be based on the fair value of that shares. So since it's not giving cash, it's giving shares. So we'll just get the market price of that shares, multiply by the number of shares it's giving us. So the transaction price is 50,000. So if we are dealing with a non-cash consideration, the fair value is just the fair value of that non-cash consideration, if there is non-cash consideration there. However, it's possible for share price to change. If it change, revenue is not adjusted. Is the date at which the contract was executed, is the price at that date that we use. If the share prices changes afterwards, we cannot recognize revenue. And a scenario where consideration is payable to a customer, that's also would impact your transaction price. So for example, you have Fast Goods Limited, sells product to a retailer for 1 million naira, but agrees to pay the retailer 200,000 for in-store marketing. I mean, this is the transaction. I'm paying the customer. So that means your revenue is just 800,000. This is straightforward. Because it's still relating to the same goods. I sold goods to a customer for 1 million. And I'm now paying the customer for advertising my goods in a store for in-store marketing. So my revenue is 800,000. However, if what I'm paying for the customer is for another service, so yes, I can treat that payment as a separate expense, not as a reduction in revenue, but in this case, it's relating to the same goods. So my revenue on that good is 800. So that is what we mean by consideration payable to a customer. So you see, I've given you scenarios for just for you to be able to see the practicality on each of them.